The boy who cried wolf is a story that we all tell our kids in the hopes that they will never lie to us. And after the words of Jerome Powell today, no one is taking him at his word. After a small dip following his speech, the markets bid up and rallied to weekly highs. Small caps, mid caps, bonds, technology, everything gained. Did Jerome Powell just give the market another green light to rally, or is Wall Street setting up another bull trap for retail? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. And today was a very strong day, a very strong day, great breadth across the board. Sure, the big names, Microsoft, Google, Meta was sold off, as well as Tesla, but you have a look at the rest of the market. Very green in cyclicals, industrials, real estate, especially regional banks put up a very good day. Utilities, just everywhere was really green, healthcare too. It was just really tech and semiconductors, and even then, it was just like the mega cap tech, software and info. Software put up a very good day, all things considered. And the SPX just closed at its highest level ever since, I believe, March 2022. We closed, above this high, and the next high is sort of like this area in 2022 in March. Very bullish close, especially in mid caps, especially in small caps. They put up like big bullish candles, like very minimal wicks. It was just a gap and go for smalls, for mids across the board. And the further we go into December, the more we get of these Vanna and charm flows, which essentially is just dealer hedging, dealer positioning, and just dealer supportive flows, particularly in the first week and the second week, as well as the third week up until OPEC. So, for the next 3 weeks in December, we were in this window of weakness up until the end of November. We stayed relatively flat, and now as we enter into December, as we enter these flows, we're starting to see some more of this dealer hedging. And in a positive gamma environment, dealers buy dips, sell rips, and we just sort of do this in a positive gamma environment. And what boosted the market today was Jerome Powell's words. He started off his speech by saying rate cut talks are premature and more hikes could come. And then he went on to say, these strong actions we have taken have moved our policy rate well into restrictive territory, meaning that tight monetary policy is putting a downward pressure on economic activity and inflation. Monetary policy is thought to affect economic conditions with a lag, and the full effects of our tightening will not have likely been felt. And the market liked this. The market liked the fact that Jerome Powell, the Fed share, was acknowledging the fact that there are lags in the monetary policy and the full effects are likely to come, and we should get weakening data in the next coming months. And this is why yields dropped significantly across the curve, especially in the longer end. You could see they dropped 2.26%. The 10-year hitting 4.217% yield. The price action in yields was crazy today, and TLT were really bid up after what was already a very strong week for bonds as a whole. And what investors are doing is just locking in these yields, because it's likely that these yields will beat the rate of inflation, because we are seeing deflation. We got ISM manufacturing PMIs today, came in as expected, but still a contraction below 50, as well as the Fed's nowcast CPI. We are actually seeing deflation month over month at negative 0.01. This is deflationary. And the Fed fund rate futures changed significantly after Jerome Powell spoke. Just 3 weeks ago, we were pricing in a 27% chance of a 25 basis point rate cut. In March, we're now pricing in 62.2% of 25% of a 25 to 50 basis point rate cut. And we're now expecting 5 rate cuts all the way to 400 to 425 basis points, the federal funds rate. And here's the expected returns that you can get in the 20-year and the 30-year for a 50 basis point fall. 11% in the 20-year and 13% in the 30-year. But these are just paper returns. We look at them as a gauge. Here's what has actually happened in history. And this is, the bond bear market returns from a bottom. So let's take 1981, for example. Bonds fell 14.6%. In the next year, they rose 43.1%. Same thing in 1932. Bonds fell 15.4%. And then the recovery from the trough, 18.5%. Literally 9 months later. Very interesting stuff. So bonds do make recoveries once they've troughed, and our trough in the 20-year treasury has been 53.2%. So I wonder what our recovery will be, and I wonder how long that recovery will go on for. And that's why fund managers are the most overweight bonds they've ever been since the GFC. funds are very, very overweight bonds, and they do expect bonds to be the best performing sector in 2024. But let's talk about sentiment. And we got the latest sentiment survey. 48.8% of people are bullish, only 19.6%, less than 20% are bearish. And I still think we need to see this number increase more before we do see any deeper form of correction. I do think we need to get more bears in here and more neutral people in here before we do see any type of significant sell. And I do think it's going to take probably all of December, even mid of January, to get this number to above 50%. And we're also seeing this sentiment shift in places such as XLP, XLU, XLV. Insiders are selling the least amount of stocks ever in these names. We can see the best performing names over the last 5 days: GDX, regional banks, real estate, home builders, staples, utilities, all outperforming the SPY. And these are all defensive sectors that'll protect you against deflation. And even despite all of these gains we're seeing in real estate, regional banks, gold miners, which are often small and mid caps, smalls and mid caps are still highly undervalued in comparison to pretty much everything else. Global markets, US value, US large cap, US growth. There's opportunity here in small caps and mid caps in the future. And what does exposure in these industries look like? This is an index I've been looking at, and you can maybe go ahead and find ETF products linked to this index. But the Morningstar Developed Market Technology Moat Focus Index, it provides exposure to the top 25 wide and narrow moat stocks in the Developed Market Technology Index, with the lowest current market price and fair value price determined by independent research. And long story short, what you're getting out of this is stocks in this mid cap, small cap range. You are getting a couple of large cap stocks as well that are high growth, high quality, average size, and really good value. 17 PE for tech stocks, and you're getting 70% in the US, 30% non-US, so you are getting international exposure as well. And if you actually go ahead and look at the annualized 15-year returns for this index specifically, you're looking at something like 18+% every single year. The 10-year returns are like 15%. So, if you do want to look at small cap, mid cap exposure, look at stuff like this, developed markets, healthcare mode focus, technology mode focus. You want to find stocks that are great quality in the mid cap and small cap sections, because there are a lot of low quality names in the small caps. What about the market as a whole? Is the market cheap? You could say it's a little bit expensive. It's trading at 18.7 PE, but if you're looking at compared to 2020, 2000, 2022, 18.7 is still pretty cheap, all things considered. But PE is dependent on earnings, and it looks as if earnings are set to grow. We just come out of an earnings recession, and we are expecting earnings of $246 in the SP 500, coming off $221. Now, on average, we do miss by about 2 or 3% every single year, as you can see. But if we are to build a margin of safety into this price, let's say 241, we then are expecting about a $20 return. In terms of earnings growth, that would be anywhere from 9 to 10% earnings growth with a margin of safety built in. Without a margin of safety, we're looking at anywhere from 12 to 14% earnings growth in the S&P 500. And I think this is why a lot of people are allocating a lot of money into stocks right now. We're seeing this end of year rally because fund managers are trying to get in on this for 2024. But how about we switch gears, guys, and talk about oil? The OPEC meeting went on, right? They said they were going to cut production. They did, but crude fell another 2% after the 4% it fell yesterday. What the market is seeing is that even though production cuts were agreed to, they don't believe that these cuts are going to be enforced. But I'm actually not that bullish on oil next year. What I am kind of bullish on is gold. Gold has absolutely rallied so far this year, up 14% from a negative return in just October. So gold has absolutely rallied. And I think a lot of people are seeing rate cuts coming, and they're looking at gold and saying, hey, when rate cuts have previously happened in gold, we've seen significant rallies of 189% in 2000, 66% in 2004, 50% in 2020. And we are expecting rate cuts here in the Fed and gold to rally as well. It's why we're seeing $2,000 gold. And I do think we probably get to like maybe 2,200 sometime in 2024. That should trade. Let's look at seasonality. 72.2% of the time, December tends to be up about 2.9%, 3% in the month of December. Very, very bullish. The S&P 500 today returned 0.57% on the 1st of December. But if we look at the monthly seasonal chart, what we can expect is just a bit of choppiness all the way up until the 16th, where we will then get our rally into year end, the Santa rally. Now let's hop on the charts and see what we did today. A very bullish day on the SPX. We actually went ahead and broke the 4600 level. Very, very bullish. we actually are closing in on the highs here at 4617. Looking into next week, I do think that we are going to go ahead and break the highs we made right here. And zooming in, look at this candle. Very, very bullish candle right here. And I don't think these gaps are going to be filled in 2024. A lot of people think gaps need to be filled. I don't think that's going to happen. I think we're just going to chop around here before we just run up into the end of the year. That's my prediction at least. And before we go, let's have a look at small caps. This is the IWM, and have a look at this candle. Absolutely insane. The strongest candle of this rally we've seen right here. And this chart looks very, very strong. This looks like a very, very strong rally to go ahead and break the 192 and possibly the 200 level in December. If this continues, we're really going to go ahead and break this in the month of December. And I am bullish on small caps into 2024. And looking at some unusual options activity today, very, very big volume as a whole. We had 46,000 options contracts trade for the full day. 59% calls, 41% puts. So people are really, really bulled up on calls. But if we actually look at some of the culprits up here, Salesforce, a 7.6 times 90-day volume. We almost never see them in the options chain. It's really good to see them there. Good volume coming through. Coinbase, another 7.2% gain today. They've absolutely soared in the last couple of days, last couple of weeks, sorry. But then we also have seen sort of puts stabilize on the big ETFs. If we have a look at the SPY, puts and calls roughly about the same, as well as the Qs. This was heavily skewed towards calls just a couple of weeks ago when we had that massive end of October to November run in the indices. So, you know, even though we are seeing a ton of calls right here in the stock indexes that do matter, that do push a ton of volume, especially in the structured products such as the Qs and the SPY, we are seeing puts and calls stabilize right there. Or however, the Russell too, you know, very stable puts and calls. And a lot of people are getting bulled up on the Russell, and we've seen the Russell heavy on the put side for the better part of the whole year. So it's really good to see a rotation from calls, from puts into calls there for the Russell. Looking at some dark pools, I saw this chart float around on Twitter, on X. Go ahead and follow me on X, on Twitter, as well as on YouTube, guys. Hit the subscribe button below. And I saw this chart here with a bunch of huge buy orders coming in at the end of 2023. And when you look at something like this and you see these huge amount of orders come in so quickly, this is normally funds buying. That huge amounts of shorts aren't going to come in after we've had a negative 22% year in 2022, because this is the start of 2023, and we're seeing the start right here. And we're going to keep a close look on this chart. If we see huge trades come in, it's going to be a very bullish signal as funds are looking to add SP 500 exposure to their portfolios for 2024, as we do know a lot of funds are underweight equities at the moment. Now, what can we expect for the week ahead? This is the SP 500 daily average returns. These are just averages since 1950. Now, we are at the 4th of December on Monday when we open. We can expect a 0.16 percentage increase, and then again on Tuesday and again on Wednesday, and then a fairly muted day Thursday and Friday. So that's what we can expect right there. But if you've made it up until here, guys, thank you so much for watching. If you like this video, leave a like, subscribe, hit the notification bell, leave a comment. You know I love you guys.